Hi there, welcome back to ET. Now you're watching Market Cafe with me, Kanishka Sarkar and Ashesha Advaryu. Well, all eyes on the RBI MPC policy meet outcome today, and at least 77% of the polled economists are expecting no rate cut. But Ashesha, what else is the street penciling in?
Well, yes, Kanishka, as you rightly mentioned, the expectation largely is that we are not expecting a rate cut this time around. But remember, the odds of rate cut have risen after the announcement of 25% tariff on India came in from US last week. So after that, clearly the odds of rate cut have risen. But despite that, largely the expectation is of a no rate cut. Now, earlier, 97% economists expected that is no rate cut, and now that has fallen to 77% after the imposition of 25% tariff. Now, to put things into perspective, repo rate currently stands at 5.5%, SDF rate at 5.25%, SLR and CLR at 18% and 4% respectively. Factors at play continue to remain very in support of the economy. So IIP stands at 20-month low. We have CPI, which currently stands at 2.1%, which is at the 77-month low, and concerns continue to weigh heavy on the Indian economy. As far as growth estimates are concerned, remember, the actual GDP growth for the fourth quarter of FY25 stood at 7.4% and 6.5% for the full year FY25, which was at a 4-year low. As far as growth forecast is concerned, remember, RBI has estimated FY26 GDP forecast to come in at 6.5%, IMF at 6.2%, World Bank 6.3%. So broadly, estimate of GDP for FY26 ranges anywhere between 6.2 to 6.5%. Now, as far as CPI estimates are concerned, in April this year, RBI was predicting CPI for the full year FY26 to come in at 4%, but it was then lowered to 3.7% in the June estimate that came in. As far as GDP estimates are concerned, RBI is penciling in 6.5% GDP for the first quarter, 6.7% for the second quarter, and 6.5% for the full year FY26. But Kanishka, yes, as you mentioned, largely the expectation is of a no rate cut this time around. But we also spoke to a whole host of experts on what the key expectations are from the MPC meet. Let's go across and listen into what they had to say.
Going into FY27, where because of the base effect, most certainly inflation will look higher than the 3.2% average that we're talking about, at least in terms of our forecast for FY26. So it will be harder to cut then it will be to cut now in terms of the inflation outlook point of view. And, transmission both to the lending rates and the deposit rates, that's something. But I think also we need to think about transmission to another important factor, which is the small savings rates.
If we believe in this particular theory that inflation will be crossing 4% in Q4, let's look at this kind of a situation. We lowered the repo rate to 5.25, and maybe after 2 months when you call us on this panel, we'll again say there will be a divided view. Again, we'll say lower it to 5%. We'll actually be talking of a real rate of around 1% or 1.25%. And today, of course, it looks 3%, now go down to 1.25%. So I think I'll go with what the governor said. We need to be forward-looking.
Today, the issue is demand. And the supply side measures in terms of liquidity and rate cuts may not be sufficient enough to boost credit demand just because of one more additional rate cut ahead of the festive season. They've already done a little too much, which is 100 basis points rate cut, given 11 lakh crores of liquidity, another 2.5 lakh crores impending. Transmission of the same is already underway in the system, not yet complete. So they can wait for that to go through.
Given that growth is likely to slow down in H2, when government spending may not be adding the kicker that it is adding right now, it's best time for giving private consumption and private investment a chance by lowering rates by 25 basis points when inflation is not a concern.
All right, so all eyes on RBI policy outcome later today, but let's also